Good afternoon, and welcome to the Deep Dive. Wow, this past week, it really felt like it threw everything at us, didn't it? Inflation worries, policy shifts, just a lot to unpack. So today, we're digging into Friday, September 26th, 2025. We're using the Bulls, Bears, and the Bell report as our guide here, trying to make sense of what exactly pushed and pulled the U.S. markets. It was a key day, you know. The major indices finally snapped that three-day losing streak, but looking closer, it wasn't really a simple story of relief at all.
No, it really wasn't. It was a fascinating day, actually. You had these two big kind of opposing forces hitting the market at the same time. And that's really our goal today, right? To break down those dual forces. So on one hand, you definitely had this wave of, let's call it macro relief. The inflation data that came out in the morning, it calmed some nerves about the Fed.
Yeah, you could almost feel the market take a breath like it had been holding it all week, waiting for that number.
Exactly. So that provided a bit of a tailwind, for risk assets generally. But, and this is the tricky part, almost simultaneously, you had this sharp policy friction coming from the administration. New tariffs were announced, really targeted ones, and that just created this huge divergence under the surface, sectors splitting apart.
So the policy stuff didn't totally kill the rally, but it made it very uneven. Like winners and losers were being picked right then and there based on policy.
Precisely. It acted like a scalpel, not a sledgehammer.
Ah.
The broad market held up, but beneath that, it was all about which companies benefited from these new rules and which ones got hurt. Supply chains, domestic production. That suddenly became key.
Okay, so looking at the scoreboard, the S&P and the Dow did rebound, broke the losing streak. But what about the overall market mood? Did the fear actually subside?
Well, yes and no. The mood did improve, but selectively. The main indices finishing green suggests that sort of systemic anxiety eased up a bit. And we look at the VIX for that, right? The quote-unquote fear gauge. It dropped about 1.73%, down to 16.45. That's not insignificant. That signals the biggest fear, the one hanging over everything, that the Fed would suddenly turn hawkish. Because of strong data earlier in the week, that specific fear got neutralized by the inflation print.
Okay.
But under that calmer surface, investors were scrambling. They were repositioning fast based on those tariffs. So the focus shifted dramatically towards, company-specific risks, industry risks, all driven by policy.
All right, let's unpack that first part then, the economic piece, the PCE data.
Yeah.
You said this was the catalyst for that initial relief. Why was this particular report so crucial on Friday morning?
Yeah, everyone was waiting for 8:30 a.m. Eastern. That's when the August Personal Consumption Expenditures Price Index dropped. We hear a lot about CPI, Consumer Price Index, but PCE.
Right.
That's the one the Fed officially hangs its hat on. It's their preferred inflation gauge when they're making decisions. It uses a slightly different mix of goods and services, sometimes gives a slightly different picture.
And the numbers themselves, they weren't showing inflation collapsing or anything, right? It was more like they just weren't bad news.
Exactly right. Not spectacular, just neutral. They landed pretty much exactly where Wall Street expected. And right now, in line is basically good news. Headline PCE was up 0.3% for the month. Core PCE, which strips out food and energy, that was up a bit less, 0.2%. And the yearly core PCE number, it just held steady at 2.9%. We also saw personal spending was actually pretty strong, up 0.6%, better than forecasts. So the consumer is still out there spending.
That point feels really important. The market rallied because the news wasn't bad, not because it was actively good. Because leading up to Friday, the market was selling off because the economy seemed almost too strong, wasn't it?
It was. That's the paradox we're in. Earlier in the week, we got stronger GDP numbers, decent labor data, and the market got spooked. The fear was that this underlying strength meant inflation was maybe picking up steam again, or at least not cooling fast enough. So if Friday's PCE report had come in hot, say 0.4% or higher month over month on the core, oh boy, the market would likely have panicked. Fears the Fed would have to delay rate cuts, maybe even scrap them for the year.
So the inline number just stopped that negative train of thought in its tracks. It sort of neutralized the immediate threat from the earlier strong data. It basically said, okay, maybe growth is okay and inflation isn't re-accelerating right this second.
That's exactly how it was read. It gave the Fed, quote, the green light to continue with the bias to cut rates this year. That's the interpretation. The market thinks the path to easing policy later this year is still open if the data keeps behaving. No more upside surprises, please.
And you saw that confidence reflected almost instantly in the Fed funds futures market. Right after the PCE data hit, the probability of a rate cut at the next meeting, it jumped from about 85.5% to nearly 88%.
Wow. Okay.
That 2.5% jump might not sound huge, but in terms of market pricing, it means a decent chunk of uncertainty. That immediate rate hike fear
Yeah.
just got priced out.
But doesn't that make the whole situation feel a bit fragile? Like we're cheering for data that's just okay, not actually showing rapid progress towards the Fed's 2% target. We're sort of walking a tightrope, needing everything to be perfectly moderate. Oh, absolutely. It highlights the fragility, no doubt. We are definitely, as you say, walking a tightrope. Or maybe dancing on a knife's edge is better. Any data point from here that hints at acceleration wages, another inflation metric, even jobs, it'll immediately challenge that 88% probability. Friday's rally wasn't a declaration of victory over inflation. It was more like a collective sigh of relief from investors that the immediate danger of a policy mistake by the Fed seemed averted for now. Big difference between fundamental strength and just tactical relief.
Okay, this is where it gets really interesting then, because just as the big picture seemed to be calming down a bit, the policy side just threw a huge wrench into specific parts of the market. These targeted tariffs. You called it policy friction.
Yeah, perfect pivot point. We go from the broad macro story to this very specific micro industrial policy story. The administration rolled out several new actions, and they hit very specific industries like shockwaves. This wasn't like a blanket tariff on everything from one country. This felt much more strategic, surgical almost.
Let's get into the details. What were these policies? The pharma one sounded particularly dramatic.
Oh, the pharma one was the big headline grabber. A massive 100% tariff, 100% on branded and patented pharma products coming from foreign manufacturers. But here's the key part. It only applied to companies that lack U.S. production facilities. And they weren't messing around. They said effective October 1st. At the same time, a 25% duty was slapped on imported heavy trucks. And then there are these strong hints, these signals about potential future tariffs on things like imported kitchen cabinets, bathroom vanities, furniture, consumer goods.
Well, 100% tariff is basically a ban, right? It makes importing those drugs impossible. You'd think that would just crush the whole pharma sector. But like you said, the fine print mattered hugely here.
It mattered entirely. The market read it instantly. This wasn't seen as just a tax to raise costs across the board. Investors interpreted it correctly, I think, as strategic industrial policy. It wasn't about protectionism in the old sense. It was about incentivizing and rewarding domestic production. That exemption was everything. If you're a big pharma company and you already have plants in the U.S., or you're building them, you're shielded, and suddenly your foreign competitors who don't have that U.S. footprint, they're facing an impossible cost barrier. You gain this huge competitive moat practically overnight.
So it penalizes the foreign firms without factories here, and it basically hands a massive advantage, almost like a subsidy to the domestic giants by knocking out their lower-cost rivals.
That's precisely the mechanism. And that drove the massive bifurcation, that split we saw in the market on Friday. It instantly became a stock picker's game. You couldn't just buy a healthcare ETF. You had to know which pharma companies were positioned to benefit from this policy wall. The tariffs were clearly seen as a tool to push companies towards U.S. manufacturing, reward those who comply, and redirect capital towards domestic supply chains. Clear winners, clear losers, drawn along policy lines.
And this policy friction then fed directly into how the different indices and sectors performed. Let's look at the index moves first, kind of the top-level view.
Right. So thanks mostly to that PCE relief, the broad indices did show resilience. The S&P 500, it finished up 0.24%. The Dow Jones did even better, up 0.47%. Solid gains broke that losing streak.
But the NASDAQ 100, the tech index, that was basically flat, right? Down just a tiny 0.06%. That divergence seems telling. Money moving around under the surface.
That's exactly what it suggests. The strength wasn't in the high-growth tech names that usually lead the NASDAQ. It was more in traditional value areas, industrials. That late-day weakness in tech hinted at maybe some profit-taking, especially in areas with high valuations. We can talk more about the AI theme later, but it fits that picture. And when you drill down into the specific sectors that did well, the link to those policy announcements is crystal clear.
Industrials were a standout winner on Friday. What was driving that strength? Was it just the truck tariff?
It was mainly two things, actually. First, yes, absolutely, the 25% heavy truck tariff. That was a direct boost for domestic manufacturers. You saw PACCAR stock just surge on that news. But second, the sector also got a lift from some positive company-specific news for Boeing, which is a huge part of the industrials index. There were reports the FAA might be starting to ease up on its oversight, particularly around aircraft deliveries.
Okay. That's been a major headache for them, right?
Yeah.
Getting planes out the door.
A massive bottleneck. So any sign that logjam might be easing is seen as very positive for their production, their revenue, their cash flow. That helped lift the whole sector.
And healthcare, or more specifically, those big domestic pharma companies, they were really the poster children for benefiting from policy, weren't they?
Oh, absolutely. The market didn't waste a second. As soon as that 100% tariff news hit, with the domestic exemption, you saw shares of the big U.S.-based players, Eli Lilly, Merck, Pfizer, all climb more than 1%. Investors just did the math. This tariff makes it incredibly hard for foreign competitors without U.S. plants to compete on price for their key patented drugs. That gives the domestic giants a huge structural advantage.
Even parts of the technology sector benefited. But again, it seems tied to policy, semiconductors.
Exactly. It wasn't broad tech strength. It was specific. U.S. chip makers like Intel, Texas Instruments, they got a lift. Why? Because reports surfaced that the administration was looking at another new plan to boost domestic chip manufacturing, reduce reliance on overseas fabs. The market sees this continuous government support, the incentives, the CHEPS Act money. It's treating these companies less like regular tech firms and more like, well, strategically vital national assets.
Okay, now let's flip the coin. The losers. The policy victims, or stocks, dragged down by other issues. Consumer staples was the only S&P sector actually down on the day.
And that's fascinating because staples are usually defensive, right, where money hides in uncertain times. But the entire sector finished in the red almost solely because of one stock, Costco. Costco's performance dragged the whole group down. We absolutely have to dig into why Costco fell, because what management said tells us more about the consumer than almost any piece of economic data we got.
Right, we'll circle back to Costco. What about consumer discretionary, particularly companies relying on imports?
Yeah, they got hit hard, especially the home furnishings retailers, and this was based purely on the threat of future tariffs. Companies like Wayfair, RH, Williams-Sonoma, they import a lot of bulky goods. When the administration starts talking about potential tariffs on imported cabinets and furniture, the market reacts instantly. It means a potential big hit to their costs. Do they eat the margin hit? Do they try to pass it on and risk losing sales? Investors hate that uncertainty, so those stocks came under immediate pressure. Shows how sensitive they are to supply chain policy.
And it wasn't just U.S. companies feeling the heat. The pharma tariff had international ripples, too.
Oh, big time. That's globalization for you. A policy change in the huge U.S. market can hammer foreign companies that rely on selling here. We saw pretty sharp drops overseas. Sumitomo Pharma in Japan was down over 4%. The whole Indian pharma index fell over 2.5%. It underscores that Friday's policy wasn't just about helping U.S. firms, it was actively taking market share away from foreign competitors.
This detailed look at policy impact sets us up perfectly for the next section, looking at the individual stocks that saw the biggest moves. Let's start with the winners. Intel had a really strong day, up somewhere between 3.7% and 4.7%. What was the story there?
Intel was really interesting because it felt like a narrative shift. The big catalyst was a Bloomberg report suggesting Apple might be considering some kind of strategic investment approach towards Intel. Now remember, Apple ditched Intel chips a few years back for its own silicon, so any hint of them coming back into the fold, especially potentially as an investor, that's seen as a massive vote of confidence.
So it's less about Intel's own chip tech suddenly being amazing again, and more about validation from a giant like Apple, plus maybe the government support angle.
Exactly. It reframes Intel's turnaround story. It's not just about them struggling to catch up on manufacturing tech internally. It becomes a story about strategic partnerships, national security, government backing for domestic chip production. That's a much more compelling narrative for big investors than just maybe their next chip will be better. It changes the whole investment case.
Okay, now PACCAR, up 5% to 6.3%. You said this was the textbook policy win?
Yeah, if you wanted one chart to show the direct impact of Friday's policy, PACCAR's is probably it. They own Peterbilt and Kenworth truck brands. And the key statistic is that something like 90% of the trucks they sell in the U.S. are actually made in the U.S. So the moment that 25% tariff gets slapped on imported heavy trucks, competitors who rely more on bringing trucks or major components in from overseas, think Volvo, Daimler maybe, they suddenly face a huge cost disadvantage. PACCAR's market share, its pricing power, it all just got a protective boost from that policy. The stock surge made perfect sense.
And Boeing up 3%. The news seemed a bit softer, FAA easing oversight. Why such a strong reaction?
For Boeing, anything related to the FAA and getting planes delivered is absolutely critical. The intense scrutiny and the delivery restrictions imposed after their earlier safety problems have been the biggest single drag on their operations and finances. So, reports that the FAA might be preparing to ease some of those restrictions on deliveries. That's a signal that maybe, just maybe, the worst of those operational headaches are starting to fade. For a company making huge, expensive assets like airplanes, getting them delivered means getting paid. Faster deliveries mean better cash flow, better revenue recognition. That's exactly what investors have been waiting to see signs of.
We should also quickly mention Crinetics Pharmaceuticals.
Yeah.
That stock just exploded, up over 27%, pure biotech catalyst.
Yeah, that was just good old-fashioned biotech news cutting through all the macro and policy noise. They got FDA approval for their drug Palsonify, which treats acromegaly. That's the kind of binary event that can transform a company overnight. FDA approval turns years of R&D spending into a potential revenue stream. High risk, high reward, totally separate from the Fed or tariffs. Just science and regulation working out.
All right, let's switch to the laggards. And we have to start with Costco. Down nearly 3.5%, even though they actually beat earnings estimates. This feels like the most important story of the day in terms of forward-looking signals. Why did the market punish them?
This is absolutely critical. It's the market looking straight past the rearview mirror, the good earnings, and focusing entirely on the road ahead. And what they heard about the road ahead, it scared them. Costco's numbers for the quarter were fine, they beat expectations, but during the earnings call, management used one specific phrase to describe the consumer. Very choiceful.
Very choiceful. What exactly does that signal to investors? Why is that phrase so alarming?
It signals a change in spending behavior. We saw the macro data saying personal spending overall is still rising, right? That 0.6% jump. But choiceful means consumers aren't just buying freely, they're thinking harder. They're comparing prices more carefully, maybe waiting for deals, maybe trading down to cheaper alternatives, or maybe just skipping non-essential purchases altogether. And this caution is showing up especially in discretionary categories, things you don't strictly need. High-end items, electronics, maybe even clothing.
So even at Costco, which is known for value, management is seeing signs that shoppers are hesitating on anything that isn't a basic necessity. That sounds like bad news for pretty much all retailers heading into the holidays.
Exactly. Investors heard choiceful and immediately thought, uh-oh, future demand might be softening, especially for discretionary goods. Margins are going to get squeezed. That subtle, qualitative warning about consumer caution completely overwhelmed the positive quantitative earnings beat. It's a powerful reminder that sometimes how management talks about the business matters more than the numbers they just reported.
Then there was Concentrix, down over 10%. That sounds like a guidance issue.
Textbook guidance, miss. Simple as that. Concentrix gave their outlook for the fourth quarter, and their forecast for adjusted earnings per share was just way below what Wall Street analysts were expecting. Markets price stocks based on future expectations. When your guidance for the next quarter disappoints that badly, investors reevaluate the company's prospects downwards, fast and hard. Hence, the big drop.
And rounding out the losers, those home furnishing retailers, again, Wayfair down 2.6%, RH down 5%. This was the direct tariff fear playing out.
Yeah, pure reaction to the threat. These companies rely heavily on importing large items from overseas. The second the administration floated the idea of tariffs on furniture and cabinets, their business models looked riskier. A potential tariff tomorrow translates into higher potential costs and lower potential margins. Investors didn't wait to see if the tariffs would actually happen. They reduced their exposure to that risk immediately. Supply chain vulnerability getting priced in.
Okay, let's pull back again and try to synthesize all of this. Section 5. Connecting the dots across different markets. How did the PCE relief and the policy friction ripple through bonds, commodities, currencies?
Right, you have to look at how these things interact. First, equities and bonds. That PCE relief, the easing of Fed fears, that was good for stocks partly because it allowed bond yields to dip. The 10-year Treasury yield eased back slightly to around 4.16%. Lower yields generally make borrowing cheaper and provide a more supportive valuation backdrop for stocks. So you saw that classic inverse relationship play out. Lower perceived inflation risk, lower yields, supportive for equities.
But then you look at commodities, specifically oil, and you see prices rising. That seems like an inflationary pressure the Fed can't really control, right?
Exactly. This is the persistent problem. WTI crude oil got up to around $65 a barrel. Brent crude near $69.50. But why? Not because U.S. consumers were suddenly driving everywhere. It was driven by geopolitical events, supply-side risks, reports of Ukrainian drone strikes hitting Russian oil infrastructure, news that Moscow was halting some fuel exports. These are things happening far away that push up global energy prices.
So you've got this external inflationary force driven by conflict that U.S. interest rate policy just can't touch. That must make the Fed's job harder.
Immensely harder. The Fed can try to cool demand in the U.S. economy, but it can't stop a drone attack in Russia. So even if domestic inflation pressure is moderate, like the PCE data suggested, rising energy costs driven by geopolitics could keep the headline inflation number uncomfortably high. It really complicates their calculus.
What about currencies and crypto?
Well, the U.S. dollar index actually dipped a bit, down about 0.19%. That makes sense. If the market starts pricing in a higher chance of future Fed rate cuts, the dollar usually weakens a bit relative to other currencies. That's what we saw. Bitcoin, meanwhile, kept sliding. We saw this pattern earlier in the week, too. When Treasury yields were rising on that strong GDP data, highly speculative, sort of long-duration assets like crypto tend to look less attractive compared to safer yields. That pressure continued.
You mentioned earlier the AI investment story seems to be maturing. Let's dig into that. It sounds like the market's moving beyond just pure hype now.
Absolutely. We're definitely past the initial phase where seemingly any company mentioning AI saw its stock price explode based purely on a future potential. That euphoria has cooled. What's interesting is if you look at the analysis, the actual earnings for many big AI-related companies have grown significantly. But their price-to-earnings multiples, their PEs, have actually compressed. Some are even below their 10-year averages now.
Wait, PE compression. If earnings are going up, why would the multiple the market is willing to pay go down?
It means investors are becoming more discerning. They're saying, okay, you're growing earnings, that's good. But maybe the rate of growth isn't justifying the incredibly high valuation we gave you 6 or 12 months ago. Or maybe they see future growth slowing. The market seems to be shifting from rewarding potential to demanding proof, tangible profitability, real return on all that investment in AI infrastructure, not just announcements about building massive data centers.
And the big sell-off in Oracle recently might be a prime example of this skepticism.
I think it is. Oracle's pouring billions into cloud and AI capabilities. But the market seems unconvinced about how quickly and how profitably that investment will translate into sustained, accelerating revenue growth. Investors are looking past the splashy headlines and asking harder questions about monetization. That lack of clear, immediate proof seems to be weighing on valuations, even for established players making big AI bets.
Which brings us right back to that nuanced picture of the U.S. consumer. This feels like maybe the most critical piece of forward-looking intel from Friday, bridging the macro data and that Costco commentary.
Yeah, you have to hold both ideas at once. The macro data, like personal spending up 0.6%, shows resilience. People are still spending money. But then you have the micro-level qualitative insight from Costco. The consumer is being very choiceful. That's the crucial reality check.
So the capacity to spend is there, but the willingness to spend freely, especially on non-essentials, is maybe waning. More caution, more price sensitivity.
That's exactly the takeaway. It suggests consumers are shifting their dollars, probably focusing more on necessities, maybe delaying bigger discretionary purchases, definitely looking for value. For businesses, especially retailers selling premium goods or relying on impulse buys, that points to potential headwinds. Pressure on sales, pressure on margins, as they likely have to compete more on price to move inventory, especially heading into the holiday season.
Okay, let's look ahead then. Section 6, the week coming up, September 29th to October 3rd. It sounds like the market's focus is going to pivot sharply from inflation data to the labor market.
Yeah, absolutely. After Friday's relief on the PCE front, all eyes turned to jobs. And we're still stuck in that weird good news is bad news world when it comes to strong economic data. The calendar is a bit back-end loaded, really building towards the big one on Friday. The employment situation report. That's the one the Fed watches like a hawk alongside PCE.
Befor we get to Friday, what are the key data points people should watch earlier in the week?
Tuesday's important. We get consumer confidence, how are people feeling, and also JOLTS job openings, which gives a sense of labor demand, how many jobs companies are trying to fill. Wednesday, we get the ADP employment report, which is sometimes seen as a preview for Friday's official numbers, though the correlation isn't always perfect. And crucially, we get the ISM manufacturing index. That's a big one. The ISM surveys give us the first real look at how manufacturing activity fared in September. Is it still contracting? Is it stabilizing? That's a key growth indicator.
But Friday. Friday is the main event, the one that could potentially reverse all the good feelings from last Friday's PCE report.
Without a doubt. The employment situation report. It includes non-farm payrolls, how many jobs were added, the unemployment rate, and the really critical one right now, average hourly earnings. After all the mixed signals on growth and inflation, this comprehensive look at the labor market will either reinforce the idea that the Fed can cut rates or potentially blow that idea up.
And you're saying the wage component, average hourly earnings, is the absolute linchpin. Why is that the metric everyone's laser focused on?
Because wage growth feeds directly into services inflation. And services inflation tends to be much stickier, much harder for the Fed to bring down than goods inflation. So if we see average hourly earnings come in surprisingly strong, suggesting the labor market is still really tight and employers are having to aggressively raise pay to attract or keep workers, that immediately sparks fears of a wage price spiral. That kind of number would likely cause the market to rapidly price out those expected rate cuts. The Fed couldn't cut if wages are accelerating, right? On the flip side, if we see modest job growth and, importantly, a cooling in wage gains, that would be seen as the perfect soft landing scenario the market is hoping for. Very bullish.
We also have a big corporate earnings report this week. Nike is the only Dow component reporting, right? That feels like it could be a significant tell for consumer spending.
Yeah, Nike reports their fiscal Q1 results on Tuesday evening, and that report will be watched incredibly closely. It's really going to set the tone for the whole discretionary retail sector, especially apparel and footwear, as we head towards the crucial holiday shopping season. And the expectations, well, they're pretty grim, frankly.
Grim sounds right. Analysts are forecasting a huge drop in earnings per share compared to last year. The consensus is around 27 cents, which would be down something like 63%. Revenue expected to fall too, maybe around $11 billion.
Exactly. So, with those headline numbers expected to be weak, the market's focus shifts entirely to the commentary from management. What are they saying about the business? Two key things investors will be listening for. First, what's happening with consumer demand, particularly in Greater China. That region's been a huge growth engine, but also a source of volatility for them lately. Second, how are they doing managing their inventory levels? Remember, all the supply chain chaos during the pandemic, many retailers, Nike included, ended up with too much stuff. Are they successfully clearing that excess inventory without having to slash prices too much? Or is that still weighing on margins?
Okay, so let's try to tie this all together. We had the macro relief from PCE data, but then this sharp policy friction from the tariffs. What's the big picture takeaway from Friday?
The big picture, I think, is that the market is caught in this tug of war between two powerful and often conflicting forces. On one side, you have the potentially stabilizing influence of the Federal Reserve. If inflation behaves and if wage growth doesn't accelerate, that's the hope for rate cuts providing a floor. But on the other side, you have the very active, very disruptive hand of government, industrial, and trade policy. And that policy is creating huge winners and losers, sector by sector, company by company, almost regardless of the macro picture.
And it really felt like on Friday, the biggest winners weren't necessarily the companies with the coolest new tech, but the ones who were positioned correctly to benefit from those government policies or strategic alliances.
That's exactly the dynamic we saw. PACCAR surging because of a tariff, Intel rallying partly on government support narratives. And that leads us right into our final thought for you, something to consider as you watch the markets this week. We just talked about how the AI investment story is maturing, how the market's demanding proof of profit now, not just hype. We heard from Costco that the consumer is getting choiceful, maybe pulling back on discretionary spending. So if you put that together, the AI boom perhaps needing to prove itself, the consumer maybe being a bit more cautious, yet you see stocks like PACCAR and Intel soar based primarily on policy tariffs, government support rather than just pure organic demand or groundbreaking tech. Here's the question to mull over. Could the next big phase of market leadership be defined less by finding the next truly disruptive technology and more by identifying which companies are simply best positioned to benefit from targeted government industrial policy? Is the game shifting from pure innovation to policy alignment? That changing landscape, I think, is the strategic puzzle every investor needs to grapple with right now.